This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Start of a fresh 5-day week. Not a holiday shortened week, a full week. This is Monday morning. We're coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning. A 5-day week and so many cues to track as well. But the market has been okay, sideways. It's just that the mid and small caps are starting to get a bit tricky now. So that is where a bit of caution should lie. But otherwise, not too bad.
Well, not too bad. And when you come off a long weekend as well, things feel good, right? So we're ready to take on the 5-day week. And then we get a couple of weeks where we get 4-day weeks.
When is the next one, Nigel?
The following one. The folling one after that as well.
That's a 3-day week, I think, right? There's one which is...
No, I think both are 4.
Both are 4 days, okay.
I'm guessing so.
No, I think there is 1 week where there is I think there's a Monday and then a Friday off.
As long as it's not a 5-day week, it's good. Right? So we pull through this
All right,
one.
this one is a 5-day week, so let's kick it off. And we're looking forward to it. It's going to be a big one because of many factors. And let's just sort of pick up from where we left off last Thursday, right? And that's the last trading session because, I mean, then the Friday was a market holiday. So, you know, if you want to summarize, U.S. jobs data was the big data point which was to be expected on Friday as we sort of as we said goodbye on Thursday, right? And we got that. Now, the market reaction actually was quite sort of a flip-flop because first markets thought that the jobs data is actually pretty strong because the numbers were strong. But then slowly the realization happened that the numbers actually are soft, weaker because the detail was weaker, not the headline jobs number, but the detail was weaker. And as a result of which, everything turned. Equities actually ended down. So if you look at the Nasdaq over the last 2 days, that is a cumulative change over Thursday and Friday, it is only 0.35% up. But each of the days, Thursday, we had a 1% plus move, and then Friday, we had a 1% plus move. 1% up, 1% plus down. That's essentially the story over the last 2 trading sessions. And it was largely on the back of course, I mean, the reversal on Friday happened on the back of the jobs data. This is, again, I mean, the change cumulatively over Thursday and Friday, which we will react to. Not very much. The 10-year is down 3 basis points, neither here nor there. And, of course, you've got the dollar index, which is weaker at about 102, under 103, 102.71, which is not exactly bad news for the market. It's good news. Dollar lower is good news for emerging market flows. Now, this is the number, right? So it was construed to be, I'm using the word construed because still there is a fair bit of debate whether this is a healthy number, bad number. But it was the market reaction at the end of the day is what matters. And it was taken as a dovish number. Headline job addition was strong, but unemployment rate, average hourly earnings were all weak. I mean, the numbers were weaker than what the estimates out there were. Now, what does it do? I mean, it basically brings forward expectations that the one data point which the market wanted, the US market wanted to sort of come off a little bit, it was running too hot, was the labor market data, and that is actually coming off. So maybe the economy is starting to weaken as planned, as desired by the Fed. But we will not hear from any Fed members because they're in a blackout period ahead of the March FOMC. The big data point, there's going to be one more data point, which is the core CPI number this week. And I think this will be the big one that perhaps the last and the big one which we get before we get into the March FOMC, where no change is expected. I mean, the first cut still is expected only in the middle of this particular year. China's NPC sort of ends. That's the big conference there. Yields in China have fallen in 11 of the past 12 weeks. I found that data point pretty stunning. And that basically shows you that the market is extremely worried about the deflationary sort of tendencies in the economy, especially with regards to the property sector there. Here in India, I mean, I think, you know, we've been broadly okay. Something or the other has been firing and not allowing the market to come off, even as broader markets, mid caps and small caps have come off, right? I mean, for example, last week, the Nifty did nothing, but the small cap index was down 3%. So stocks in many sectors, in many areas are off 10, 15%, if not more. But sort of circling back to the Nifty levels, we need to break above 22,600 broadly. Those are Fibonacci extension levels for the uptrend. I mean, that's essentially logically the next target. We're pretty much at all-time highs. And on the downside, I mean, Wednesday's low, which is 22,224, should be defended. I mean, only if you get a break under it, below it, you basically say that the up move is under some threat. And on the Nifty bank, I mean, some supports here really. The question has been whether, for example, Wednesday on Nifty Bank, we saw a big rally. There was no follow-through on Thursday. So I'm just putting out support. We'll see if the Bank Nifty looks strong and moves up. But supports are at the hourly averages, 47,800 and then 47,490. These are very, very near-term support levels. For the large caps, I mean, the trade, of course, has been to buy the dips. But it's not very clear because there is a divergence in the broader market, which is weaker, which is consolidating, and the large caps, because of something or the other firing, which continues to move higher. So the large cap indices are still telling you to buy the dips, whereas the broader market, there is a bit of distribution and come off and tapering off, which is happening. Sonia.
Absolutely. I take your point entirely. While the headline index may not be showing the kind of pressure, we saw on Thursday the mid-cap index was down about 1%. Yeah. So the Nifty is holding on to those levels of 22,500 thereabouts, but the real pressure really is kicking in to the broader market. So there is a shift that we're seeing from mid and small caps to large caps. Just look at what's happened this month so far. The Nifty is up 2.5%, while the Nifty mid-cap index is up just 1.3%, and the Nifty small cap index is actually down 1.7%. So the best way to trade so far is to be prudent, to stay cautious in the mid and small cap space. On Thursday also, if you saw, there were a lot of smaller banks that were under pressure, whether it was UCO Bank, IOC, etc. So keep that on your radar, that banks could be a bit vulnerable to the price action going forward as the pressure builds up in the mid and small cap space. In terms of flows, yes, there was very large numbers that came in. FI is about 7,300 crores, but it looked big on Thursday because of the large block deals that took place. So there was a large block deal on M&M where the promoters sold 93 lakh shares worth almost 1,800 crores. There was a large deal on Bharti Airtel as well, where Singtel sold about 4.9 crore shares at 1193 rupees a share. So keep an eye out on that. I'm also watching out for some of the insurance companies this morning because there was very strong insurance data that came through on February. More on that later. But three companies in focus: Max Life, SBI Life and ICICI Pru. Both the premium data has gone up substantially. The Feb premium for Max Life went up 51%, but even the APA data is strong across the board. So, this is one space that could gain a bit of traction this morning. But other than that, I think it's the broader market that beckons a bit of attention because there's definitely some risk off that has come through, some money that's being taken off the table. So I would be a bit cautious there.
Well, that's right. And March is normally a volatile month, right, for the broader markets because there is, some kind of profit taking, some kind of tax planning as well. But on Thursday, market participants said enough of this narrative with regard to being cautious in small caps because the small cap index actually was a relative outperformer in comparison to the other indices as well. And, yes, the index has been underperforming, but stock-specific action continues, and I'm just pulling out some of these examples, no big fundamental view on any of them, but there are select stocks that are doing very, very well. So though the index is underperforming, there are a lot of stocks that are giving you opportunities actually to make a lot of money out there. So be very stock-specific action. Don't throw on the towel. Continue looking at some of those stocks in the broader markets, and they're making you big money as well. Now, looking at the Nifty itself, the key trigger for the Nifty to move up from here on is going to be the Nifty Bank because that's close to around 1.7% away from its fresh all-time highs. If it can get to that mark, well, you'll have the Nifty that will be moving, towards the 23,000 odd mark. So that's the key trigger out there. Ahead of the long weekend, we saw some unwinding of positions. Both on the Nifty and the Nifty Bank, open interest was low on both of them. And the FI positioning as well, they lightened positions and they lightened more amount of shorts than longs. So the short positioning did come down quite a lot. And they continue to remain net short with close to around 58% positions on the short side. In absolute terms, it's around 33,000 contracts. So they remain net short, but not aggressively net short is what I would like to say. On the option side, the 22,500 call and put, both of them were very active, and that's what we call a short straddle. What is it? You pocket the premium of both these two. So, on an average, the total premium you would pocket is around 300 rupees. You pocket that and you say that the Nifty should expire in this range of around 22,200 on the downside to around 22,800 on the upside. So it appears there is a strategy that's at play. And the 20 DMA comes in at around 22,130 or thereabouts. So till that level is holding out, you'll have to say that this market is still in an uptrend. And the Nifty will continue to trend higher as well. Now, the stock that I'm looking at is PVR. The stock ended at the high point of the day. We had the release that, Shaitan, the Ajay Devgan thriller. And after a long time, you're going to be getting 100 crore net collections. So maybe the street is looking to that. Valuations as well in comparison to its average is a little better, though quarter four is going to be soft. So it appears at around this 1350 level odd, that's where you're seeing some buying. That was the low that we saw the last few sessions, and that's the 52-week low as well. So 1350 is an important level that it holds out on the downside. And there was big delivery-based buying as well in Thursday's trading session. So keep an eye out on the stock. It seems to be bouncing off the 1350 odd level. The question is, does it have enough to go ahead and conquer higher levels? Case in point, the 50 DMA. So that's a stock I'll look at. The GIFT 50 suggests a gap up. We'll have to see whether or not the bulls can build on from there.
Okay, by the way, guys, the Oscars are on currently. They're live at the moment. And, you know, the winners are coming through. I think Christopher Nolan is one for Oppenheimer and even Cillian Murphy, right, for the movie.
I told you guys, right?
Yeah. So Prashant is really vindicated, you know. I think you watched the movie 4 times.
3, I think. Yeah.
Wow.
9 hours.
It was worth it. It was worth it. Yeah. And there's one person who can say, I told you so. But the Oscars are on and we'll continue to get you updates on who the winners are. For now, the one winner that we can hear of is Cillian Murphy, Best Actor for Oppenheimer, and Christopher Nolan for directing the film. But more on that in a bit through the course of the day, actually. Let's kickstart the show. On the equities front, you have Sanjeev Prasad of Kotak Institutional Equities, who says the broad-based rally in PSU stocks is largely driven by top-down bullish sentiment for PSUs in general, rather than any major bottom-up structural fundamental developments. They see several problems with the euphoric sentiment for PSU stocks. First, bullish short-term profitability and volume assumptions. Second, incorrect valuation methodologies. And third, unrealistic narratives. He adds several PSUs are trading at absurd valuations. The fact is they're trading at, FACT is trading at 126 times FY24 estimated EPS. Hindustan Copper is trading at 119 times FY24. And IRFC is trading at 3.8 times FY24 estimated book value. So his basic point is that, be cautious in PSUs.
Well, that's Sanjeev Prasad for you. We'll get you some money market views as well. B. Prasanna of ICICI Bank says that the dollar softened as February U.S. jobs data, along with earlier month revisions, indicated an ongoing rebalancing of the job market in the U.S. He says a softer dollar and seasonal flows helped the rupee perform better, and a sharp appreciation was countered by RBI intervention. For the week, he says currencies will take cues from February inflation data, and he expects the rupee to trade between $82.6 to $83 on the currency. Yeah.
All right, and on the bonds, V. Prasanna says the global yields continue drifting lower on the back of softer economic prints and in-line payroll data. Back home, he says strong investor demand and easing liquidity led the positive momentum going. He says with inflation release due this week, he expects markets to trade cautiously, with the 10-year benchmark bond yield likely to trade in a range of 7 to 7.08%.
All right, we got a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We're looking at IIFL Finance, Life Insurers, DB Realty, Torrent Power, Dwarike Sugar, and HG Infra. All of them will be reacting to positive news flow. While on the flip side, you have the Tata Group stocks, Indiglobe Aviation, JM Financial, and Z Entertainment. All of them will be reacting to negative news flow.